Good morning, everyone. This is Barry Knapp with Ironside's Macroeconomics. It's Monday morning, July 26th, the last week in the month of July. It's a big one. Tomorrow morning, we'll get house price numbers for the month of May, although it's somewhat stale data. We still think that house price story is pretty critical to the Fed decision on tapering or not tapering asset purchases. Big tech earnings, of course, really ramp up tomorrow night after the close. This is the biggest week of earnings season, which so far has been pretty good. We get the FOMC meeting on Wednesday, the first look at two-quarter GDP on Thursday, another week of jobless claims, and that's shaping up to be a pretty interesting story, which we'll come back to shortly. So there were four components of our report this week that was released on Saturday, the 24th. The first one we titled the Gamma variant. It was a bit about market action last week. Next section was flood season is ending. This is all about the amorphous liquidity in the markets, primarily from policymakers. That's been such a topic of conversation, which we go into in great depth this week. A section titled Labor Bottlenecks Are Clearing, and a final section on earnings season titled Margin Mythology. To begin with, we jokingly referred to what happened last week as the Gamma variant because the move in volatility last Monday, when we had that at one point, what was a 2% decline, was outsized even relative to that sharp drop in the markets. And then, of course, we had a ferocious snapback through the balance of the week. We really don't think that Delta variant is going to have a big impact on policy. We doubt very much there's going to be anything in the way of lockdowns, though certainly in places that are prone to that. Australia, for example, when you saw the flash PMIs last week, Australia seems to be going for eradication, not controlling the virus. You saw a really sharp decline in their service sector PMI. We don't expect too much of that, but certainly we do have some lingering policy issues in terms of extended and expanded unemployment benefits in about half the states. It could weaken the hands of FOMC participants that are arguing for an immediate end to the asset purchase program. So in that respect, it may have some policy impact, though we would not buy equities or position on the long side based upon a one meeting delay in that taper process. Say they do take a pass this week and push it out to September. We think that's effectively picking up nickels in front of a steamroller because we do see that correction as a consequence of starting the reduction in asset purchases as imminent. So that's it on the markets. We did discuss a little bit stock bond correlation and how it changed in the 60s. We still very much expect that to be the case. And we introduced an ETF that we think you all should do a little work on and consider, called PFIX. It's effectively an ETF that invests half of the money, or invested half of the money, in intermediate term treasuries and the other half into a very long duration, 7-year swaption payer struck at 4.25%. So it will benefit if rates rise over time. And the gamma profile of it, the theta profile, all the Greeks is really pretty good. So we think it'll carry nicely. You won't get just chewed up if nothing happens. It's a pretty good marker to have down for higher rates over time. But you should do your own research on this. We spoke with the architect of it last week. It's a pretty cool ETF, but do your own work, please. The next section of the report was really the heart of the report this week, was all about the liquidity dynamics in the markets. And so you hear a lot about Fed asset purchases and how that's created liquidity in the market, and that being the reason that the bond markets had this surprising rally, the drop in rates back down to as low as 112 basis points on nominal 10 years last week. Real 10s, or the TIPS yields, are down to negative 108 basis points or so. It's pretty surprising given the state of the economy, the outlook for inflation, and outlook for Fed reducing purchases. Those Fed purchases really haven't changed at all. The big surprise for the markets this year more than anything was the Treasury draining their account at the Fed, which was about $1.7 trillion at the beginning of the year. And it's on its way to supposedly $450 billion by the beginning of August. We're almost at the end of this process. But you could see that this draining of liquidity came in waves, and it had impacts on the market, we think, for sure. The first wave was in February and March, when the Treasury sent out checks to individuals. That caused a very sharp decline. That was the probably peak in speculation in various asset classes, crypto and the meme stocks and the like, as individuals were getting money and putting some of that money to work, pardon me, in the markets. At the same time, though, bank deposit growth was surging. There was another wave of liquidity related to the banking system generally in April after earnings, when the large banks issued some 50 billion in bonds and notes over the course of a couple of days. That money had to get put to work in the Treasury market as well. And then when the Treasury really slowed bill issuance in May, we had another surge of liquidity into the system from the Treasury drawing down their general account at the Fed, and that money winding up in bank reserves. As this process has been going along, the Treasury, or the banking system has been accumulating treasuries. They've probably, looks to me like they've bought about $500 million so far this year, which was not really in the offing at the beginning of the year. So we are, the broad point around all this is that we're almost at the end of the process. You've seen the deposits in the Fed's RRP program, where the banking system, until the June meeting, was receiving nothing for putting the money in the RRP system, but it was better than repo rates going negative. After the June meeting, they were getting 5 basis points. Those balances surged from about 100 billion at June quarter end to nearly $1 trillion. They sit at about 900 right now. But again, that ought to get drawn down as we get into August and through the second half of the year, in part because loan demand is starting to pick up. We've already seen it at the consumer level. We showed a chart of this in our weekly, and we think it'll pick up for businesses as well, commercial and industrial loans, as bottlenecks start to clear and inventories get rebuilt. We go through a whole inventory restocking process. There'll be needs for working capital, trade credit, all those sorts of things, and we'll start to see those balances decline, and all this liquidity that's been creating this just voracious bid for treasuries will start to dissipate pretty soon. I mean, this balance, drawing down the balance process is supposed to be done by August 1. So we're at the end of this process. The liquidity won't dissipate immediately, but it should start to fairly quickly. So long-winded way of thinking that they're saying that the factors, the forces that created this voracious demand for treasuries are about at their end. And you can throw global trade and the surge in our trade deficit into the same category. That should start to dissipate in the second half of the year as well. And though we don't expect our trading partners to stop intervening on behalf of their currencies and creating a bid for treasuries. Note, one of the things I neglected to mention was in May, the Chinese started intervening to stop their currency from appreciating. So again, that created more demand for treasuries. But these factors are all starting to peak, and they should dissipate, and the rates should start to rise again in the second half of the year. On the labor market and bottlenecks, the latest week of continuing claims across all 3 programs had a 1.2 million continuing claims decline. Now, the pace of that decline has been pretty constant since going back to March. In March, we had 17.3 million total continuing claimants across all programs. By April, it was 16.4, so a 900,000 decline. May was 15.6, so an 800,000 decline. June, 14.8, an 800,000 decline. The July average right now is 13.4, so that's a 1.4 million decline. But as I said, the latest week was a drop of 1.2. So it looks like the labor market bottleneck is really starting to clear. Morning Consult released a survey that determined that 70% of people receiving claims expected those claims to expire by the end of August, and half of them felt urgency to go out and look for a job. So we think even if the Fed takes a pass this go around, it's likely that the next two employment reports will be very strong, and that will be considered substantial labor market progress, even by the most dovish members of the Fed. People like New York Fed President Williams, San Francisco Fed President Daly, or Chicago Fed President Evans will probably all have to admit that there's been substantial improvement in the labor market. So that's critical to the policy outlook going forward. Final section of the note was titled Margin Mythology. And just with 25% of earnings, companies having reported earnings, we thought it was very notable that when you look at revenue surprise, so the biggest beats on revenues, number one was the consumer discretionary sector, number two, financials, three, materials, four, industrials. On the earnings surprise front, again, the biggest positive surprise, consumer discretionary, followed by financials, then industrials and healthcare. So if you think about it from that perspective, the consumer discretionary sector is beating on earnings and beating on revenues. It implies that these companies are having success passing through higher prices to the ultimate consumer. And Fed officials ought to be considering that a little bit as well when they think about price gains being transitory and their whole thesis about demographics being destiny. And that's why we've had low inflation for 3 decades. We really just don't believe that that's the case. We had a windfall from a giant labor supply shock coming out of China. That's why prices were low. Service sector prices have been increasing by better than 3% for decades. This is not, this is a much, the inflation risk is much bigger than Fed officials think, but it also means from a corporate perspective, there is positive operating leverage. And we showed a chart this week underscoring how profit margins are almost back to peak. And that is what happened in the early 60s. Revenue growth went up, fixed costs remained the same. There was positive operating leverage, and earnings growth accelerated from 8% in the 50s trend to about 15%, at least through the first half of the 60s. So that's the main message we take away from earnings season so far. That's good underlying news. It's why if we get a drawdown, as we expect from Fed policy, you're supposed to be a buyer of that, because the forward-looking outlook on the equity market is fundamental outlook, at least, is quite favorable. So that's it for me this week. Again, we'd like you to consider becoming a subscriber. There's lots of details about this whole liquidity dynamic in there, so you can really dig in and understand it. And we do think a big change is coming. Barry Knapp, Ironsides Macro. Have a good week, everyone. Thank you.